Google's parent company, Alphabet, just dropped its second quarter earnings report, and it seems like AI is supercharging the company's growth. They didn't just meet expectations, they blew right past them. But at what cost? Today, we're going to be breaking down the key numbers and why the company is raising its spending plan to a massive $85 billion this year. Let's get into it. First up, revenue. Wall Street was looking for around $94.5 billion. Alphabet delivered a massive $96.4 billion, a 14% increase from last year. Next, profitability. The consensus for earnings per share, or EPS, was about $2.20. Alphabet crushed that, posting $2.31 per share. Search revenue also grew a very healthy 12% to $54.2 billion. Alphabet CEO highlighted how their new AI features are actually getting people to search more. AI overviews, those AI-generated summaries at the top of your results, are now driving 10% more queries when they appear. With that, Google's AI mode already has over 100 million monthly active users in the US and India. And get this, Google Lens searches, where you search with your camera, well, they're up 70% since this time last year. For some time now, there have been valid concerns that generative AI could negatively impact Google's core search business. The primary worries were that AI summaries would cannibalize clicks to advertisers' websites, or that the high cost of AI queries would erode profitability. However, this earnings call painted a surprisingly different picture, positioning AI as a powerful growth engine. At least for now, AI is not a detractor, but actually a significant driving factor, expanding the utility and volume of search rather than hindering it. YouTube also had a fantastic quarter, with ad revenues growing 13% to $9.8 billion. Now, with all this being said, if there was one star of the show this quarter, it was Google Cloud. Cloud revenues surged 32% to $13.6 billion, surpassing the $13.1 billion analysts had been hoping for. But even more impressively, its profitability skyrocketed. Cloud's operating margin jumped from 11.3% last year to 20.7% this quarter. That's fantastic. So why the insane growth? Well, demand for AI. Alphabet CEO stated that nearly all generative AI unicorn startups are using Google Cloud. Also, usage of their Gemini AI models on the platform is up an incredible 35 times compared to last year. Companies are rushing to build AI tools, and a huge number of them are choosing to do it on Google's infrastructure. So how is Google fueling all of this AI growth, you may ask? Well, by spending a colossal amount of money. Following the earnings announcement, Alphabet stock did experience a brief dip. The reason primarily driven by the company's raising its planned spending to approximately $85 billion for the year, a $10 billion jump. This sparked initial investor concern about the impact on short-term profitability. However, as the market digested the report, the sentiment does seem to have shifted, leading to a stock rebound. Investors now appear to be focused on the reason for the spending, overwhelming and accelerating demand for Google's AI and cloud services. While the report was overwhelmingly positive, management did outline a few headwinds for the second half of 2025. The primary challenge stems from difficult year-over-year comparisons for its advertising businesses, specifically after the strength in financial services and the surge in ad spending during the 2024 US elections. On the expense side, Alphabet does anticipate continued pressure from depreciation related to their massive capital investments in AI infrastructure. And finally, the third quarter will also be impacted by marketing expenses from the upcoming launch of the new Pixel family of products. Now, before we finish up here, let's go take a quick look at the company's stock over on Yahoo Finance. So here we are taking a look at Alphabet Inc., stock ticker GOOG. Right now, it's sitting at around $194 a share, up 1.47% from yesterday. This is over the last 5 days. As you can see here, we've got this blue bubble. All right, this is the earnings. We have an estimate PE of 2.2, EPS actual 2.31, so that's a 5% beat. People like that. That's good. So we saw this big spike here in the after hours trading, but as you can see here, when the market opened, there was actually a pretty big dip. Now, with that being said, overall, the stock is still up. Now, this dip, I would attribute it. It seems to be that the market sentiment around what's happening here is people's concern over that giant capital expenditure for their AI. It's hard to tell what's going to happen in the future, but at least in the short term, it does seem like it's paying off. So, we'll have to see. Now, if we take a look at these yellow bubbles here, these are analysts updating their ratings. So the first one we got here is JP Morgan. They're maintaining their overweight rating. So overweight means that they expect the stock to outperform the underlying index or the underlying sector. Alphabet is part of the communication sector. Along with that, they're raising their price target from 200 to 232. That would be pretty nice, going from 194 to 232. that would be pretty significant. So for the next one, we have Oppenheimer. They are reiterating their outperform rating and raising their price target from 220 to 235. Not too bad. And the last one here, we have Raymond James. They are reiterating their outperform rating just like the other two, and they are raising their price target from 185 to 210. So every one of these analysts, they seem to be, well, they're raising their price targets, and they all expect the stock to outperform the underlying sector. So good news for Alphabet stock. Investors will certainly like to hear that. Now, if we take a look down here, we got a market cap right now of around $2.34 trillion. That's one of the big ones. All right. We have a PE ratio of 20.7. This is trailing 12 months and a trailing 12-month EPS of 9.38. With a current dividend of 84 cents a share, and that works out to around 0.44% per year. So this is not a giant dividend paying stock, but at least there's a little something. Now, if we take a look back at this PE ratio here, 20.7, if we compare that to, we have XLC right here. This is the communication services sector ETF. There is a PE ratio on the sector of around 20.57. So only slightly higher for Google. For people who are looking for stocks that are fairly valued, that's a pretty good sign, especially given the fact that they've been seeing pretty reasonable growth year over year. Now, moving over to stockanalysis.com here, we have GOOG, so Alphabet, XLC, again, that's the communications sector ETF, and we have VOO, which is the S&P 500 ETF. VOO, or the S&P 500, is kind of a reflection of all of the different sectors combined in the United States. So VOO is a good reflection of sort of how the market's doing overall. Now, if we take a look here at 5-year returns, we actually have XLC here at the bottom, communication sector, VOO in the middle, and Google outperforming with 145% return. That's pretty darn good compared to XLC's 96% return. Now, if we move over to 1 year, all right, we actually see that's a little bit of a different story. So there were 2 reasonable dips here for Google stock. So if you held the stock for just over the last year, or you held all 3 of these, Google would actually have the lowest return at 4.96%, 15.81% for VOO, so the market as a whole, the S&P 500, and 28.28% for XLC, the communications sector. Year to date, all right, it's a pretty similar story. We got the same here, Google at the bottom, XLC at the top, and VOO right here in the middle. Now, over the last month, we actually can see here that Google has been outperforming. So hopefully Google here, especially with the news around the fact that AI seems to be driving more search, which that was a big concern for people, hopefully they can keep up with this trend and continue outpacing the market, which would be fantastic for people holding Alphabet in their portfolios. Now, I do like to point out the fact that I'm not a financial advisor, so if you do plan on making any investment decisions, speak to somebody who is qualified. Because remember, investing always carries risk, and the most important thing, past performance does not equal future performance. So, what's the final verdict? Well, this was an incredibly strong quarter for Alphabet. AI is no longer a future promise. It's a present-day growth engine, boosting search and attracting a flood of customers to cloud. While the company did note some potential headwinds, the overall momentum is undeniable. Alphabet is putting its money where its mouth is, betting tens of billions that the AI revolution is just getting started. So what do you think of Alphabet's earnings? Is their AI strategy a clear winner? Or is it just way too expensive? Let me know your thoughts down in the comments below, and if you enjoyed this breakdown, don't forget to hit like and subscribe for more deep dives into the world of finance. Thank you for watching.